You ever hear about a business deal that was so badly timed it should have been a complete and utter catastrophe, but instead it turned into the single most profitable private equity deal in history? Well, you're about to. This is the incredible story of how one of the world's biggest investment firms turned what looked like certain disaster into an absolute masterclass. And this number? This is what it's all about. $14 billion. That's the profit Blackstone made from one single investment in Hilton Hotels. To give you some perspective, this is pretty much considered the biggest home run in the history of the industry. Just a truly staggering amount of money from one deal. So you have to ask, right? How did they pull it off? What was the secret sauce? Was it some kind of brilliant foresight, flawless timing, an unbeatable plan right from the get-go? Well, the crazy thing is, it was none of those, not even close. In fact, it was the exact opposite. The secret to the most profitable deal ever, believe it or not, starts with what was objectively the worst timing you could possibly imagine. We're talking about a deal that was signed at the absolute tippy top of the market, literally moments before the entire global economy fell off a cliff. Okay, so let's set the scene. The date is July 3rd, 2007. The world is just buzzing. It's the middle of this massive leveraged buyout boom. And the giant investment firm Blackstone decides to go all in and buy Hilton Hotels for a jaw-dropping $26 billion. It was a massive bet on the future of travel and hospitality. And when I say it was a massive bet, I mean, just look at how they structured this thing. Blackstone only put in about $5.6 billion of its own money. The rest of it, over $20 billion, or a whopping 78% of the deal, was all borrowed. They were leveraging up to the hilt, betting that Hilton's profits would keep climbing so they could easily pay it all back. Now, here's a little piece of financial jargon that turned out to be an absolute lifesaver. Covenant-lite debt. You could think of this as their secret weapon, even if they didn't know how critical it would become. It basically meant that as long as they could scrape together the interest payments, the lenders couldn't just come in and snatch the keys to the company if profits tanked. And boy, were profits about to tank. So, just 3 months after the ink was dry on this massive deal, the music stopped. The 2008 global financial crisis hit like a tidal wave. Travel completely seized up. Hotel rooms were sitting empty everywhere. For Hilton, this was the absolute perfect storm, and Blackstone was sailing right into the heart of it. The damage was just brutal. Hilton's earnings completely collapsed. The value of Blackstone's investment just plummeted, forcing them to write it down on their books by a painful 70%. That $5.6 billion check they wrote? Poof, suddenly it was worth less than $2 billion on paper. The situation looked absolutely hopeless. I mean, to make matters worse, 2 of the banks that loaned them all that money, Bear Stearns and Lehman Brothers, they went bankrupt themselves. The whole deal was drowning in debt, and pretty much every expert on Wall Street was predicting that Hilton was going down next. Bankruptcy didn't just seem possible, it felt inevitable. So, with their backs completely against the wall, Blackstone made a really critical decision. They realized they couldn't just fix this with financial tricks. They had to fundamentally change the company itself. And that kind of change, well, it always starts with leadership. They went out and hired a new CEO, Chris Nassetta, a real veteran of the hospitality world. And he was not there to make small tweaks. I mean, this quote says it all, right? He immediately moved Hilton's headquarters from Beverly Hills all the way to Virginia, and then replaced nearly 80% of the corporate staff. He was building a whole new team from the ground up. And this was the light bulb moment, the single biggest strategic shift that saved the entire company. Nassetta and the team at Blackstone realized that the real value wasn't in owning all these expensive hotel buildings. No, the real gold was in owning the powerful Hilton brand. So they decided to get out of the real estate business and into the brand business. Just look at this comparison. It tells the whole story. Before, Hilton was asset heavy. It owned tons of buildings, which costs a fortune and is super risky when the economy turns. The new model was asset light. Hilton would sell off its hotels to other investors, but keep long-term contracts to manage them or franchise the brand. This meant they could just collect high-margin, predictable fees without tying up billions in bricks and mortar. It was a game changer. So, if you boil it all down, their entire turnaround playbook really had 4 key moves. Step 1, bring in that transformational CEO. Step 2, make that pivot to the asset-light model. Step 3. They poured money into technology and their Hilton Honors loyalty program to build a direct line to their customers. And step 4, they used this new model to expand like crazy all over the world, especially in China, without having to buy a single hotel. Okay, so after years of this intense transformation, Hilton wasn't just saved. It was a totally different, better company. It was lean, it was growing fast, and it was incredibly profitable. By 2013, it was ready to go public again. But Blackstone didn't just cash out and run. Nope, their exit strategy was a masterclass in patience. Check out this timeline. They took the company public in 2013, but sold 0 shares at the IPO. That's a huge vote of confidence. Then, for the next 5 years, as the company's value kept climbing, they slowly and strategically sold off their stake. They even made a massive $6.5 billion sale to another group at a premium price. By the time they sold their very last shares in 2018, the price was over $83, more than 4 times the original IPO price. So let's just tie this all together. From the absolute brink of bankruptcy to a historic payday, how in the world did the deal with the worst timing in history somehow end up generating a record-breaking $14 billion profit?
This table really breaks it down perfectly. You know, the clever financial moves like buying back their own debt on the cheap during the crisis, yeah, that helped, but it was only about 20 to 30% of the final profit. The vast majority of the value, almost half of it, came from pure operational excellence, actually changing the business model, launching new brands, and investing in tech. They didn't just rescue the company, they fundamentally rebuilt it into something better.
And that really leaves us with one final thought, doesn't it? The whole saga of Blackstone and Hilton proves that a deal's success isn't just about your entry point or having a perfect plan. It's about what you do when that plan gets punched in the face. So it kind of begs the question, not just in business, but maybe in life, what's more important? Having the perfect plan from the start, or having the grit and creativity to pull off a brilliant recovery when everything goes wrong